We're in the commodities industry, and we're changing the way it can be financed. So I suppose we're sort of a banking platform, a financing platform for critical minerals, which we need. I don't know, is anybody here aware with how stuff ends up on shelves in supermarkets, in factories to be turned into, cars? It relies on the commodities industry and the commodities industry supply chain, and typically that relies on finance. Trade finance. So that is, similar to inventory finance, where you would take a charge on the inventory while it's in storage. Trade finance takes a charge on the inventory while it's in transit. This is being chronically underserved, and it's getting worse. I've been in the commodities industry for 20 years. In 20 years, we've seen many of the banks pulling back, and we see a liquidity gap. There is not enough money flowing to the flows of these raw materials.
Why are the banks reversing it?
Because it's
The risk profile that they have.
lots of reasons. So regulation, Basel III, MiFID, lots of things that have made it regulatorily difficult. But principally, if you want to play in the physical commodities space today, you have to engage in an industry that hasn't really changed since documentary trade was invented by the Lombards in the Middle Ages. It's very paper heavy, it's very old school, it's high complexity, it involves complex jurisdictions, it involves complex processes, things that can leak, explode, go off. It's just too high risk, and in the banking environment, it's not really worth getting out of bed for. Much easier ways to deploy increasingly scarce balance sheet. And we're all paying the consequence because there's an inflationary cost of finance in commodities that was passed on eventually to the consumer. And this trade finance gap is growing. And in fact, the world, I think it's the Asian Development Bank has done quite a lot on this. They think it's about $4 billion potentially of gap. Sorry, $4 trillion of gap. $4 trillion gap in trade finance going forwards. So it's getting worse. And when we look at critical minerals, so these are the things that we need for the energy transition. And, forget about cobalt and, battery metals. Just copper, for example, one of the most important parts of the electrification that we're all hoping for in the world. This has to come from increasingly difficult places. And so this is a problem of complexity that's getting harder, not easier for financiers. So we need to find $1.7 trillion of new critical minerals. This is new supply of materials currently not flowing. It will come from complex places that banks don't want to work in, that traditional finance don't want to operate in, and it will carry significant risk that will almost always be mispriced. So who currently profits from this dislocation? You may have read about them or heard about them. Glencore, Vitol, commodities trading houses. There is a reason why they are driving Ferraris around the Swiss Alps. It is extremely lucrative if you can deploy balance sheet in this supply chain. So, energy transition requires critical minerals. When we talk about critical minerals, we talk about 37 different types of minerals. But as I mentioned, just copper alone, without copper, new supply of copper, we have no grids, we have no wind technology, we have no generation, we have no electrification. So $200 billion a year of material that is currently not financeable has to flow into the marketplace to meet even the least ambitious energy transition goals. I mentioned complexity. The complexity is twofold. People don't typically, energy transition investors are very happy to invest in wind farms. They are very uncomfortable to invest in mining assets. There's lots of very good reasons for that. There are a lot of complexities and social hazards around mining. Exposure to mining is different to exposure to critical minerals supply chains, and it's different to energy transition. But without it, we will not have the energy transition. Mining itself is getting harder. If you want to build a high-quality copper asset, mining asset, near a deep water port in an OECD country, you are 50 years too late. all of the new supply will come from places that are perceived to be high complexity and high risk. A lot of it will come from the Democratic Republic of Congo, which is a very difficult place to imagine any normal, conventional Western banking kind of environment financing. The other complexity is these assets themselves and the material, because a lot of this stuff ships as raw ore. It doesn't ship as refined copper. Every scoop that comes out of the ground is different. It has different chemical properties. It has different mineralogical properties. It makes it very hard to value and very hard to know where it's going to go. So twin complexity in geology and geography is making what is already an underbanked sector even harder to invest into at a time when we need the supply to be flowing to power the energy transition. You asked why banks? Here's some terrific examples of what can go wrong in commodities trade finance. I mentioned the guys driving Ferraris around the Swiss Alps. Trafigura, excellent company, many friends there, really good business, solid, honestly the best of the best. $577 million fraud last year on nickel that was supposed to be in a warehouse and wasn't. $577 million. That is a bad day in the office. Large copper producer in Europe, so it's not just the trading houses. Arubis, really, again, excellent, tier one company, really struggling to control inventory finance, theft, fraud, documentary fraud. This one I like, this is from a few years ago. I have fewer friends at Mercuria, so I enjoy sharing this one. Mercuria, trader buys $36 million of copper and gets painted rocks instead. $36 million transaction backed by a tier one bank for copper painted rocks. This is the best of the best. These are the ones you hear about from the companies that are flagship businesses and have to disclose how they operate. So this is a technology poor, risk rich or high risk industry. So what can we do about it? What can we do in this era of digital supply chains to bring some digital transformation to the complexity in this industry? Well, actually, the technology is already here. Immutable records are easy to access, easy to create. The technology for immutability is good. It doesn't work very well with the highly shadowy, secretive world of commodities trading, where people have box files of paperwork on their desk, WhatsApp contacts, smoke-filled rooms. It's a low transparency environment. But if you're able to perform, over time you gain a reputation. So it's an industry that works on reputation. At the moment, that reputation is organically managed, organically overseen. What can we do to make it into that kind of star rating internet provider, network effects platform business? Secondly, I mentioned the warehouse problems. Why aren't there cameras in warehouses? If you go to a pub around the corner, my first job was in hospitality. Typically, people would take a £20 note and give people £10 worth of beer and put £10 in their pocket, and £10 would go through the till 30 years ago. You can't do that anymore. There's no theft in the front of hospitality because there's a camera. We still have warehouse fraud with no cameras. So what can we do to connect to this increasingly instrumentized supply chain to change risk, to give people comfort that their assets that they're lending against are secured? And what can we do to handle identity? A lot of bank risk aversion comes from KYC, sanctions, complexity to do with who actually is the ultimate beneficial owner. There's some murkiness. What can we do to de-risk that using technology? There's plenty of standalone, there's a great business case for white label KYC business services. Why can't we incorporate some of those for the commodities industry? So this is what we've been building. And we've been building it alongside people who've proven this in the agricultural commodities sector. So our business is new, but we've licensed proven technology from digital disruptor of the agricultural trading industry. They have deployed $3 billion of capital. They've 3,000 individual trades, 0 defaults. So this is a new business. This is a kind of Series A proposition to you, but the technology itself is well proven in an adjacent industry. We are bringing it to the metals world. So what do we do? What practically are we talking about? We take the universe of data around a transaction. Who is it? What's the material? Where's it coming from? What happens if there's a default? Who owns it in the event of a disruption in the supply chain? Is it insured? Is it sanctioned? Where's it going? What's its value? What's its underlying value? All of these data points are available. We are taking them out of the many different email inboxes around the world, and we're putting them in a single place where we can make the transaction as an entity available for finance. We have a fund. We don't, but we work with a fund, which is also an interesting investment case. This is a asset-backed, typically 9% a year fund, 90-day liquidity, works with a lot of family offices, that they love lending against these sorts of cargoes and these material. So we take the complexity of the trade, we make it investable, and that will allow buyers and sellers to move material between complex jurisdictions to where they need to go. And there's plenty of margin in that. Remember the Ferraris in the Swiss Alps. We're expanding this year. We're building out our technology stack. We mentioned warehouses. Right now, the technology is really good when the vessel leaves the port, but that supply chain that we looked at there has a significant overland component. You're relying on trucking and warehouses. We're building a number of digital warehouses where once the material is deposited, we have a higher degree of confidence in the quality of the asset. We know what it is, where it's come from, and we know that it's secured. So we're not going to lose $577 million to warehouse fraud because we've got a camera and we've got security on the entrance and exit, and we have a higher degree of sign-off from two-factor authentication for inspectors, and we have integration to banking. So this is digitized supply chain. Sounds extraordinary that this wouldn't exist in the multi-trillion-dollar world of commodities. It doesn't. We're building it. 3 locations identified, building out and raising funds to extend the digital risk transformation from seaborne trade to inland logistics. Mentioned the risk transformation methodology. It's complex. Even the word commodity is complex. You know, there's a lot of jargon in here. But basically think about it as a SaaS business. We are raising equity finance for a SaaS business that takes complex data, standardizes, digitizes, makes it available to a client, which is a fund. We don't take any balance sheet risk on the commodity itself. We make that risk more understandable for people who would like exposure to it. We charge a risk transformation fee, like a platform fee, for doing this work. We have an anchor client. This is really important. This is an archaic industry that does not want to change, particularly. So finding the right early adopters is really important. Open Mineral has one of the fastest growing books of critical minerals in the world, has seeded some intellectual property to make it understandable, make the risks around their specific book understandable, and has then stepped away and is now an arm's length client, but has committed a significant amount of throughput to the platform if we're able to raise financing. We also have 8 firm sign-ups, 15 strong leads for competitors of Open Mineral, other traders in different markets, all focused on the critical minerals sector. The universe is enormous. That trade finance gap is real and is addressable and is growing. So two commercial models emerge here for 2 different investor classes. Some people like a bit of both, but full disclosure, we have the fund. We are not marketing the fund because we can't. We're not regulated fund managers, but there are fund managers we can put you in touch with. Family offices, small kind of mid-cap kind of energy transition focused investors really like it because it's a good way of gaining exposure with very low volatility of returns, very strong risk profile, and as I mentioned, about 9% a year on annual basis, going back to 2017. I'm very happy to make the introduction to the fund management business if anyone's interested. And in terms of the platform itself, we're currently owned by the founders. We have our anchor client not on the cap table, but they retain an upside. If they put a lot of throughput through the platform, they get some participation in the upside. But we're looking for, I guess, a Series A. It's probably kind of post-seed, pre-Series B, somewhere there. I'm not sure exactly, because we've got proof the technology works. We've got proof of scale. We've got expertise in this industry, and we've got our first client signed up. So we're looking for a potential equity check writer at this stage as well for the business. So I'm very happy to take any questions. If that's interesting, please do ask questions now or reach out afterwards.